Okay, Brian Perry here. We're going to run through a real live example here of how to lay on a covered call trade using a very stock that's in favor with traders in today's market here, where the option premiums are extremely lucrative and where there's a lot of potential for not just bringing in covered calls but also making some capital gains in the process. I want to start by looking at, we want to go with a hot sector in the market. One of the hottest sectors where we're seeing a lot of corporate spending is in cybersecurity software. We hear daily about the cyber attacks going on at banks and retail stores and medical systems and whatnot. So cybersecurity spending is huge. And as such, that sector has been doing extremely well with companies that are hitting new highs, beating estimates on revenues and bottom line earnings estimates. So in light of that, I want to go with a company here that's been a real strong performer in this sector called CyberArk, CYBR, Charlie, Yankee, Bravo, Romeo is the symbol. And by buying into CyberArk, we're buying into one of the leading names in technology today on the NASDAQ. Hence, it provides a really great covered call opportunity for those that want to get involved. Just as a basic example, we'll buy 200 shares of CyberArk at an average cost of $53 per share for a total amount of $10,600 in cash, or roughly $5,300 in your margin account if that's the way you're managing your covered call account. At the same time, we're going to place a limit order to sell 2 calls against those 200 shares of CyberArk. Remember, 100 shares of stock is represented by one contract, either in a put contract or a call contract. In this instance, we're selling covered calls, so we want to sell 2 calls representing 200 shares of stock. And we want to just go out to the very next month, which would be September, and use a strike price, which is the price at which we're willing to let the stock be called away from us if in fact it closes above that price on a specific day. In this instance, the September expiration is the 18th of September. It's always the 3rd Friday of every month, month in, month out. So for the September contract, all contracts expire on September 18th. Where CyberArk closes, whether it's above 55 or below 55, is important to note. But for our working model, we're going to sell 2 covered calls against this CyberArk September 55 call, and in doing so, we can bring in $3 a contract, which is option language for $300 per contract. So we can bring in $300 a contract, or since we're selling 2 calls, we're going to bring in $600 in immediate option income into your account that's going to credit immediately when you trigger that trade. So your account, because you have 2 calls you sold at $300 a piece, you're going to bring in $600 immediately in your account. That money will stay there, or you can use it right away if you care, for whatever purpose you want. But what happens there is there's 2 scenarios that take place. Come September 18th, if the stock of CyberArk closes below 55, or where you sold those covered calls, the 55 strike, you keep 100% of that $600 in your account, and you still own the stock of CyberArk. In scenario 2, if CyberArk stock closes above $55 per share, you've sold the right to somebody else to take that stock away from you at $55 or above. And 100% of the time, if a stock closes above its strike price the following Monday, that stock will no longer be in your account. You keep the premium, but the stock will be called away. Now, what's beautiful about this second scenario is you bought the stock at 53 and it's getting called away at 55, meaning the stock rallied 2 points for you in the process. Not only did you keep the $600 from the covered calls, you also made 2 points or $400 in capital gains from the sale of CyberArk at 55. The 2 $600 call premium plus the $400 capital gain total $1,000, which will be your total gain for holding that CyberArk trade for less than a month. That $1,000 gain divided by your cost basis of $10,600 is 5% if you're just keeping the covered call premium of $600. But if in fact you do have your stock called away and you have that $1,000 gain, then you've made 9.4% as a total return for the month. That's an extraordinary return and a very strong scenario for a typical situation where you're in a stock like CyberArk, where the likelihood of that happening is quite good in a good market. As we all know, volatility exists. The CyberArk moves around a lot, like a lot of stocks in the tech space, but these are the kinds of stocks that really generate the kind of call premium where if you time your trades properly, we can bring in a steady $600 a month just on 200 shares of stock, with hope that maybe we get called away once a month as well to bring in an extra 4.5% on our money. Be as it may, on the low side, if you're just collecting the $600 in premium, you're bringing in around a 5% yield. If we extrapolate that out, folks, over the course of a year, you know, the math gets a little bit exciting there. And if you're getting called away on your position and you have to go back and buy CyberArk again and redo the trade, then again you're bringing in better than 5%, somewhere between 5 and 10%. It's exciting either way, and at the same time, this is just one stock within a stable of 5 to 7 to 8 names that we'll be working with that all can generate this kind of total return. Thanks very much. Hope you enjoy the trade.